Welcome back to the channel, everyone, and in this video, we're going over 5 growth stocks that you should keep your eye on for the upcoming trading week. This is a recurring series on the channel where every Sunday, we discuss the major events taking place over the next few days and the companies who may be impacted. These events include earnings reports, new product launches, or investor presentations, and in this week's episode, we have 5 high growth companies from various sectors that you should definitely be adding to your watch list right now. And before we jump into company number 1, I'm going to ask you, as always, to please hit that like button and subscribe. If you're new to the channel, I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos, and we're going to move straight in to company number 1, which is FedEx. Ticker FTX, currently trading for $270 per share, and the company has absolutely exploded from the March lows, growing 178%. They have a current market cap just above $71 billion, and even after the massive run-up, they are trading with a very reasonable forward PE of only 15.6. And they do pay out a slight dividend with a current yield just below 1%. And from FedEx's 52-week high of over $300 per share, the company now trades down just over 10% at this current level. And they're included in this week's episode because the company reports earnings on March 18th. We have a revenue estimate just shy of $20 billion, with earnings per share to come in at $3.23. And over the past 4 quarters, the company has done an amazing job of beating analyst expectations. They've beat on EPS 4 consecutive times, and for this next report, we're projecting 129% year-over-year growth in earnings per share. And from their second quarter report, they performed extremely well. This pandemic has seen a massive benefit for FedEx services because as consumers continue to order products online, they have to be shipped all across the country. And over their previous report, total revenue crossed $20 billion, which was a 19% year-over-year growth. And net income grew to over $1.2 billion, which represents 119% year-over-year growth as well. And if we take a look at FedEx's income statement, year-over-year, total revenue continues to grow. Even before the pandemic, they were doing a great job of expanding their business, and now in the trailing 12 months, they've generated a record high of over $74 billion in total revenue. And of course, when investing in this company, you're here for the long-term share price appreciation. But we do have to mention that at this current point in time, the company does have a very small dividend yield, just around 1%, and it only makes up 15% of their total net income, which is extremely low and very sustainable. And going forward, Wall Street analysts have set very high expectations for FedEx's future growth. And we can see they're projecting over 28% per year growth for the next 5 years in the future. And at this current point in time, the company is rated as a buy, and the current share price of $270 sits well below the 12-month price target of $324. And as more consumers continue to spend more time and money shopping online, that means an increase in goods needing to be shipped, and FedEx is one of the key players in that market. And right now, there is such a wide moat to get into that industry, I don't see many competitors knocking FedEx out of their key market leadership position. So definitely an interesting company to keep on your watch list this week. They report earnings on March 18th, and really looking forward to seeing the company's latest results. And now if we continue on into company number 2, we're going to go over Advanced Micro Devices, ticker AMD. They currently trade for $81 per share, and over the past 12 months, from the March lows back in 2020, the company has climbed 107%. They have a current market cap of $98 billion, and they're one of the leaders in the fast-growing semiconductor industry. And from the company's highs of over $97 per share, they have now seen a decline of over 16%, bringing them back down to that $81 level, which I believe to be a very attractive entry point into AMD. And they are included in this week's episode because the company is hosting the launch of their new 3rd gen EPYC processor on March 15th. This is a highly anticipated event, and it may spark a rally in the share price going forward. And 2020 was a great year for AMD as well. If we take a look at their full year results, revenue grew to $9.7 billion, which was up 45% year over year over the 2019 number. And their total net income came in just shy of $2.5 billion, which was up 630%, which is absolutely incredible, and they performed amazing throughout the global pandemic. And if we take a look, they also generated record high free cash flow of $777 million, which grew 182% year over year. So record high revenue, record high free cash flow, crazy high net income. AMD is doing amazing right now. And for the 2021 fiscal year, the company has set very high projections. Revenue growth of around 37% with a gross margin of 47% overall. So very high expectations, and if they can cross this $3.2 billion mark, I think the share price will climb much higher than where it is right now. And if we take a look at their balance sheet, they have an extremely strong financial position, which is why I believe this company is very attractive. A current ratio with $6.1 billion of total current assets compared to short-term debt of only 2.4. So a current ratio well above 2 and very safe over the short term. And AMD has done an amazing job of reducing their overall long-term debt. We can see $1.4 billion back in 2016, and year over year, they have been paying that down, and it now sits at only $330 million, which is absolutely amazing. And the total debt on the business comes in at $3.1 billion, which is extremely low compared to their overall assets of close to $9 billion. So a very nice balance sheet on AMD, which is a strong sign of the company's financial health. And year over year, total equity continues to grow to a record high of $5.83 billion. And going forward, this company is projected to continue to grow at a massive rate. And we can see analysts are expecting 26% per year growth from AMD over the next few years. And they're currently rated as a slight buy, and the share price of $81 is below the 12-month price target of $103 per share. So AMD is at a very interesting point. The company has declined over 16%. They performed extremely well in 2020 and have massive future growth projections for 2021 and beyond. If you're interested in getting into a semiconductor play that isn't trading at all-time highs right now, then AMD is definitely worth taking a look at over this upcoming week. And now into stock number 3, we have Nike. They currently trade for $140, and over the trailing 12 months, the company has exploded up close to 90% from the March lows. They have a current market cap of $220 billion, making them one of the largest consumer brands in the world right now. And this company actually saw a great benefit due to this pandemic, although their retail locations were shut down all across the country. Their digital sales absolutely exploded, and those sales have much higher margins, increasing the company's total bottom line. But now as the economy continues to reopen, I think Nike has the potential to climb even higher than where they are today, because all of their in-person stores are going to get reopened and consumers are going to flock to these malls and these outlets in order to buy the Nike apparel that they were previously unable to due to the pandemic. And if we take a look, they're included in this week's episode because the company reports earnings on March 18th. We have a revenue estimate of close to $11 billion with EPS of 74 cents. And in the trailing 12 months, when most apparel companies lost between 20 and 80% of their overall revenue, Nike held up very strong. And we can see they've generated over $38.2 billion over the past year, which is only a slight decline from their 2019 number of $39.1 billion. So even throughout one of the worst economic situations in the company's history, they proved that they can still deliver incredible results. And if we take a look at their balance sheet, their financial position is very strong at this current point in time. They have over $11.8 billion of cash and total current assets of 23.6, and compare that to their short-term debt of only $8.9 billion, a current ratio well above 2, and very safe and sustainable over the short term. And similar to FedEx, Nike's a company you're buying into for the share price appreciation. But we have to mention that they do pay out a nice little dividend with a yield of 0.8%, and the payout ratio is only around 37% of their total net income. And they've been growing that annual payment, averaging 11.6% per year growth, which is a nice high annual growth rate for a company with a lower starting yield. And going forward, analysts have some massive projections for Nike over the next 5 years and are projecting 34% per year growth, which is absolutely insane. And the company is considered a strong buy right now with a 1.9 rating, and the current share price of $140 is below the 12-month expectation of $163. So another company, even though they're trading at crazy highs and have absolutely exploded from the March lows, analysts are projecting massive growth to come for many years in the future. And because they report earnings this week, definitely a company to keep your eye on over the next few days. And next, we have stock number 4, which is Dollar General. Ticker DG, currently trading for $191 per share, and the company's up by 35% from the March lows. They have a current market cap of $47 billion and are trading with a very nice forward PE, just around 18, and a current dividend yield of 0.75%. And on the longer term charts, Dollar General has seen some incredible growth. Over the past 5 years, their share price is up 125%, and over the past decade, it has climbed 566% overall. But as of late, the company is on a slight downward trend, and from a high of $221, they now sit down over 13% at this current level. So a slight pullback from a company that is pretty much essential to many consumers' everyday lives and where they shop for everyday necessities. And if we take a look, they report earnings this week on March 18th. We have a revenue estimate of $8.2 billion and earnings per share of $2.69. And over their latest quarter, they performed extremely well and net sales grew 17% year over year. Earnings per share was up 63%, and year-to-date cash flow from operations is up to $3.4 billion, which is growth of 103%. And the company also returned close to $1 billion to their investors in the form of a dividend and share buybacks, which is absolutely incredible. And if we take a look, year over year, Dollar General has been posting incredible results, and over the trailing 12 months, their total revenue number has exploded. From year-end 2019 at $25 billion, they now sit at over $32.5 billion in the trailing 12 months, which is absolutely amazing. And this is another company that does pay out a very slight dividend of 0.75%, and it only makes up around 13 to 14% of Dollar General's total net income. And going forward, this is another company with massive future growth projections of over 17% per year, and the company is currently considered a buy at a 2 rating, and the current share price of $191 is well below the 12-month level of $238. So this is a retailer that's going to open up more stores all across the country. They are essential to tens of millions of consumers' lives, and overall, this may be a main player to add to your portfolio over this next week. And if this downtrend continues, you may be able to get into Dollar General for a very attractive price. And now moving on into the 5th and final company we're going to discuss today, and that is ticker UNP or Union Pacific. They trade for $214 per share, and the company has grown from the March low of over 62%. They have a current market cap of $143 billion and are trading with a reasonable forward PE of around 22. And this is a railroad company that operates within 23 states all across the country. They are one of the most consistent brands in the world, and no matter what, railroad infrastructure is not being expanded, and the companies who control that market share are positioned to be those leaders for decades in the future. And right now, UNP has a nice dividend yield coming in at 1.8%. And over the long term, UNP has provided their investors with amazing results. And over the past 5 years, the share price has grown 163%, and over the past decade, they have grown 350%, representing an average per year growth rate of 35% per year, absolutely crushing the S&P 500. And they're included in this week's episode because this company is presenting at JP Morgan's Industrial Conference on March 16th of this week. So although UNP is considered a boring company, they're traditional, I think the overall recovery in our economy is going to give the railroads a massive boost and can send UNP shares to record highs. And if we take a look at the company's income statement, year over year, they average between $20 and $23 billion of total revenue, with a slight decline in 2020. I do think that will pick up as more of their customers can resume operations. I'm sure total revenue will come back above 21 or 22 billion over the next fiscal year. And one thing that's impressive is although total revenue has seen a slight decline, the company's free cash flow, which is a very important metric to follow, actually went up to $5.6 billion. And we can see over the past few years, that free cash flow number has increased from around 4 billion all the way up to the new 5.6 record high. So overall, free cash flow is the company's cash that they can use to expand their business or pay out in the form of a dividend. So as that number continues to grow, it is a very strong sign for the company shareholders. And if we take a look, UMP does pay out a nice dividend, yielding 1.8%. It only makes up 40% of their net income, so it is extremely safe. And over the past 5 years, they've been growing that payment, averaging 12% annual growth, which is absolutely incredible. And going forward, analysts are actually expecting some nice growth from UNP over the next few years and are projecting around 12 to 13% per year share price appreciation. And right now, the current share price of $214 sits below the 12-month expectation of $230, and UNP is considered a buy. So more a traditional and boring company that does get overlooked, but I really don't think gets enough appreciation. They've been delivering consistent and growing results, and the company's returns have been absolutely spectacular, outpacing the overall S&P 500. So definitely a name to keep your eye on, and I'm really looking forward to what they announce at JPM's Industrial Conference early on this week. So that was the fifth and final company we're going to discuss in this video. Thank you for watching to the end. As always, if you're new to the channel, please hit that like button and subscribe. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, join the community, leave me a comment down below, and I will see you in tomorrow's video.